Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm gonna go over 6 companies that you guys have asked me on the Discord. If you have not joined us on the Discord, please do so. You can either basically help the channel by paying £2 or £5, whichever you're comfortable with, and you get access to the Discord and a lot of the spreadsheets that we use as well. Okay, and obviously you'll find like-minded people. So the 6 companies I want to talk about today, all of them pay dividends, and then there are some that do not pay dividends that we'll be talking about as well in the next couple of videos. But as you can see here, the basically it looks like the portfolio is flat for the week, because it was 70,000 at the beginning of the week, and I've added about £260 this week, and as you can see right now it's £70,266. So it is flat for the week, and nothing really basically major happened this week. And as usual, I'm adding the £250 every single week, dollar cost averaging into some of the companies that I actually think are undervalued. And also I share every buys and sells on the Discord as well before I actually share with the rest of the community. But yeah, just join us if you can. That will be really helpful, and that helps the channel. Right, so today's video, the first company we're looking at is company called Intuit. And this is one of the companies that basically are very famous for QuickBooks, which is a software a lot of small businesses use. A lot of small business use. So they are a technology company. They have loads of different applications, but that is the one that they are mainly famous for. Let's do a little bit more information on this company. Again, by the way, if you're looking for more detailed analysis of each one of these companies, then you're going to have to do that by yourself by looking at their basically 10K and so on. Okay, go to their website and learn more about how the company basically sells their products and what type of products they sell, what the customer base looks like, and so on. So you can get qualitative or quantitative data basically. Okay, so the market cap of this business is $124 billion. It has a wide economic mode. $446 per share is where the price is right now. Dividend yield is very small, so just 0.70%. Latest increase with 15%. The 5-year growth rate of 15%. Payout ratio is only 23%. Dividend streak of 10 years. Okay, the annual payout is $3.12. Safety is 98%. Profit margin, return on equity, they are absolutely fine. For free cash flow of basically $4 billion. Total return 22% in the last 10 years. And then next year they're expecting 13% growth, and then 15% after that. It looks like it's really discounted right now, and it's $503 per share is where it should be. This is really interesting business. If you can get your head around how the business makes money and understand where their customers comes from and so on, and if they have a demand for their product and so on, this is actually solid business. From dividend perspective, free cash flow, and the growth side of it, and the fact that it's discounted right now, is really interesting business. Okay, and if you look at their financials, you can see actually the annual revenue basically expected to grow from right now $12.73 billion annually to next year 14.17, and then 15.78, so which is quite good. And the EPS is also heading the right directions. In terms of profitability, it actually looks good as well, from gross profit to EBITDA to net income margins. All of it is actually heading the right direction. Return on asset is not that great according to this, but it is really good business, and they have very low debt of $7.68 billion of a company that has a market cap of $125 billion. Now, one of the major things that I've actually found out about this company is the shares outstanding. So they have kind of started buying back their own shares, and then they start diluting again. So there must be a reason why they're doing that. So the fact that they have a $4 billion in the bank and they're diluting the shares, that's very interesting. That we need to find out why they what they're using for that money. But as you can see, total sales from 3.95 to right now 13.7. So that is again is in the billions, by the way. That's really good, massive growth, okay, over the last 10 years. So it's very interesting business if you're really looking at another technology company, maybe one to look at. The next one is Lint. This is one of the chemicals companies. It's very similar to Air Products and Chemicals. 180 billion market cap. It has a narrow economic mode, $366 per share right now. 1.40 dividend yield. Latest increase was 9%. 5-year growth rate of 8%. Payouts only 38%. Dividend streaks of 30 years. Annual payout $5.10. Safety 99%, which is perfect. Okay, that's the highest you can get basically. Profit margin of 12% and return on equity about 10%. Free cash flow almost to $5.7 billion, which is really good. Total return in the last 10 years, we're looking at about 14%. Next year, they're expecting 8% growth in terms of earnings, and then 9% growth every single year after that. 2% premium right now. $359 per share is what basically Morningstar is saying it should be trading right now. And in terms of revenue growth, as you can see here, basically it's expected to grow from 33.36 to 34.3, and then 36 the year after. And then same goes for as well the EPS is all expected to grow the right directions and go to right directions. And as you can see, they're growing that dividends beautifully. So yeah, it seems another great company. I actually own this one in the family portfolio, okay, that I haven't shared with you guys obviously, but I do own that one in the family portfolio. The next one is Accenture, $177 billion market cap. Again, this is another software company that works with a lot of consulting. They do a lot of consulting for companies. Basically, they help other companies use IT and basically become more efficient in their ways. It has a wide economic moat, $276 $276 per share. Dividend yield of 1.60, latest increase of 15%, 5-year growth rate of 10%, and payouts only just less than 40%, which is quite nice. 17 years of increase in that dividend. $4.48 is the annual payout. Safety is basically 92%, which is quite nice. Profit margin, return on equity is actually good. Free cash flow, $9 billion. Total return in the last 10 years, we're looking at about 13%. Next year, the earnings are expected to grow about 8.5% and then 9% after that. 9% premium right now, $258 per share is where the price should be. So again, that's the third company you guys have asked me to look at. Yes, this is expensive. I'll be honest with you, this one, I wouldn't be touching this company for a while right now. I'll be honest with you, it should come down at least 15-20%. This is solid business. This is really good company, okay? But it is expensive, and that's the only reason that I would say I wouldn't touch right now. However, looking in terms of the revenue, you can see the revenue is growing the right direction, which is absolutely good to see. And also the EPS is also growing. In terms of profitability, they're doing really well. In terms of dividend, it is really good. We've just seen that, and obviously increasing that dividend. They had a cut in 29. It looks like they had a little bit of cut, or something has happened. Maybe it was a split. Something happened there anyway, but it looks like they have been increasing that dividend for a while, which is quite nice as well. 17 years, so I'm assuming that there was something else with that situation where it looks like it was down. Apple Laboratories reported the earnings recently, and they smashed it, and they went up, I think, about 5% or whatever on that day. $181 billion market cap. Again, this is a pharmaceutical company. This is the AbbVie, basically the company that split from the AbbVie split from. It has a narrow economic moat, $111 per share is where the price is right now. 1.82% dividend yield. I would expect this dividend yield to be slightly higher, but it is what it is. Latest increase was 8.5%, 5-year growth rate of 12%, 36% in terms of the payout ratio, and 51 years of increase in that dividend. This is one of the dividend kings. And then you've got the payout, the annual payout of $2.04, safety 71%, 15% in terms of profit margin, 19% return on equity, $7.8 billion of free cash flow, and 12% total return in the last 10 years. In terms of next year, they're expecting 9% and then 8% the years after. Right now, it's flat. So it's not basically, it looks like it's fairly valued at the moment. But I'll be honest, after what is done yesterday, it should be about 2-3% premium right now. But $104 per share, where is basically the prices are. Should be, but right now it's $111. So it should basically, this should reflect that, to be honest with you. So about $5 or whatever higher than where it should be, $6 or whatever higher than where it should be right now. Apologies, I'm still struggling with my voice, but yeah. So in terms of the next company, this is Bristol Myers Squibb. Actually, before we do that, let's look at the ABT's revenue, and it looks like there is a little bit of a decline expected this year. Having said that, maybe it would be interesting to look at the latest earnings and see if that's just going to continue, because there is a decline there, and that should have reflected what's happened yesterday. But investors are normally looking at basically this quarter rather than, you know, the whole year or whatever. But it looks like there should be some sort of a decline in terms of earnings and in terms of revenue as well. So we will see how it goes. So the next company is Bristol Myers Squibb, again another pharmaceutical company, so one of the biggest one, $148 billion market cap, wide economic mode, $70 per share, dividend yield of 3.27, which is probably the highest in this list that I've got here. Latest increase was 5.6%. The 5-year growth rate is 7%, payout ratio is on 28%, and dividend streak of 16 years, $2.28 is basically what you will get. 69% safety, profit margin 13%, return on equity 19%, and free cash flow of $11.95 billion of free cash flow, which is really good. 8% total return in the last 10 years. This year they're expecting the earnings to grow about 1%, then 4% after that. It looks like it's basically trading right now a premium about 6%. $66 per share is where the price should be of this company. And again, looking at the revenue, so looking at the total revenue this year, they are expecting to grow, okay, and then the following year also it looks like it's growing. It's basically heading in the right direction. There was a massive jump from 26 billion in terms of total revenue in 2019 to 2020, 42 billion. Wow, that's a huge jump. So they must have acquired another business or something along those lines. There's always another reason why. Because remember, pharmaceutical companies are very good at acquiring other businesses, and then a couple of years later, once it becomes part of that business, the revenue can jump massively. But it looks like it's heading in the right direction anyway. And also the top 10 earnings per share is also heading in the right direction. Now, looking at the shares outstanding of this business, it was fine for a while, and then they start issuing more shares. Probably maybe in 2019, maybe that's why they start issuing more shares, because maybe that's why when they decided to buy this, maybe they bought another company around here. For whatever reason, there must be a reason why there was a massive jump in there. The final company we're going to look at today, Eli Lilly, and again another pharmaceutical company, 334 billion market cap, so one of the biggest that we've got in this list. It has a wide economic mode. $385 per share is where the price is right now. Dividend yield of 1.22, latest increase was 15%, 5-year growth rate 14%, and payout ratio 49%, which is fine. 8% and 8 years of increasing that dividend. Annual payout $4.52. Safety is 96%, which is absolutely amazing. Profit margin, return on equity is really good. Free cash flow $4.6 billion. Total return in the last 10 years, you're looking at about 21%, which is probably the highest in this list, one of the highest. And again, this is a solid business. This is why this company has been on my list for a long time, but it's been expensive all this time. Next year, they're expecting the earnings to grow 38%, then 22%. So because of that, it's trading 28% premium. 289 is where it should be right now. It needs to basically come down about $100 minimum to at least look at this business, okay? So it is really good company. I like the business model. I like the fact that diabetes side of things and everything else they do. However, it's very, very expensive. And to be honest, that's one of the reasons I actually prefer Merck over this one here. But if you look at the revenue, it's actually heading in the right directions from 28.5 to 30.66, and then 36 from there as well, which is a massive jump. In terms of earnings per share, is also heading the right direction. So again, it's a massive jump from 2023 to 2024. This is a solid business. In terms of profitability, it looks really good. They have a very low debt as well. So from every angle that I look at, this company is actually solid. So all 6 companies here are really good companies here you guys have asked me to look at. But I will be honest with you, some of them are really expensive right now. Companies like basically APT, I would say needs to come down a little bit. But for me, the one I would actually consider adding to my portfolio out of the 3 pharmaceutical companies is Eli Lilly. And obviously, Intuit is interesting. However, I do have a lot of technology companies that are undervalued at the moment. So that's why I wouldn't look at this. And like I said, I already own Lin, and Accenture is one of the companies that I would not be touching anytime soon until at least it comes down for at least 15-20% or whatever. But yeah, great companies. Let me just show you from Sharia compliance side of things. None of them actually have a massive issue apart from this one here, okay? Interest-bearing debt, 27%. So that's quite high for my liking. And again, I will be doing a video talking about Zoya and the Sharia compliant about the OIFI standards, because this is I don't know if this is sustainable, and I've got another option that I need to look at, and I will share that with you guys when I get a chance, inshallah, in the next couple of weeks. But from Sharia compliance side of things, right now as things stand, it doesn't look like basically there's a problem according to Zoya. Even you can do the financials. You can easily go into this company's website, Seeking Alpha, look at the debt, total debt, basically, which is this one, divided by the market cap. That will give you the interest bearing debt, and then you can easily find the interest bearing securities if you go to Yahoo Finance, and you can easily find the basically the cash and cash equivalents and do the maths there as well. Anyway, I'm going to stop the video right here. If you haven't joined us on the Discord, please do it, because it genuinely helps. This is the one way to help the channel, even if you just do it for 1 month, and obviously get access to all the spreadsheets that I use. Okay, once you've got a copy of that, then that's it. If I do any updates, I'll let you know, and then you've got your own copy. You don't have to make any change. And obviously you can join us on the private Discord, where you can talk to brothers and sisters who have similar sort of interests and so on. Have a wonderful Eid, okay, and we'll see you soon, inshallah. Assalamu Alaikum.